Hello, I'm glad you're here. People often come up to me at meetings, in letters, or sometimes even at the Dairy Queen when I'm enjoying a cone, and they ask, Warren, how do you pick the right stocks? How do you know which ones will build wealth? Now, that's a fair question, and it's a question I've been thinking about since I was a little boy, flipping through stock tables in the newspaper. I bought my first stock when I was just 11 years old, and I've been studying businesses ever since. So, if you're looking for shortcuts for quick money or for some secret tip that will double your money by next week, I'm afraid you won't find it here. But if you want to know the timeless principles that have helped me turn a small nest egg into something larger than I ever imagined, then stay with me. Because the truth is, picking stocks isn't magic. It's not gambling. It's about discipline, patience, and common sense. And anyone, even you, can learn to do it. So let's talk about how I approach it. Start with your circle of competence. The first and most important thing you need to understand is something I call your circle of competence. That means you should only invest in businesses that you truly understand. Now, that doesn't mean you need to understand everything about every business. Nobody does. I don't invest in most of the high-tech companies because I don't know enough about them. But what I do know is insurance, banking, consumer products, and a handful of other industries that I've studied for decades. That's my circle of competence. If you step outside your circle, you're playing a dangerous game. Imagine you're a baseball player and the coach tells you you don't have to swing at every pitch. You can wait for the pitch that's right in your zone. That's how investing works. You don't have to buy every stock. You just have to wait for the ones that land right in your circle of competence. Here's a story. Back in the 1980s, everyone was rushing to buy tech companies. It seemed like the future, and I'll admit I didn't buy them. Some people thought I was old-fashioned or even foolish, but I stayed within my circle. I bought Coca-Cola. I bought Gillette. And guess what? Those investments paid off handsomely because I understood the products, the customers, and the business models. So ask yourself, what do you know? Maybe you've worked in retail or healthcare or manufacturing. Maybe you know consumer habits in a way that others don't. That knowledge, when applied carefully, can be your edge. Stay within your circle of competence, and you'll avoid a lot of mistakes. Look for durable competitive advantages. Once you've found businesses within your circle, the next step is to ask, does this company have a durable competitive advantage? I call this a moat. Think of a castle. If you're defending your castle, you want a wide, deep moat around it so enemies can't get in. In business, the moat is what protects a company from competitors. For example, Coca-Cola has one of the widest moats I've ever seen. People all over the world recognize that brand. They have distribution in almost every country. If you tried to start a new soda company tomorrow, could you really compete with Coke? Probably not. That's the power of a moat. Another example is American Express. Their brand, their customer loyalty, and their network of cardholders and merchants create a moat that makes it very difficult for competitors to replicate. When you're analyzing a stock, ask yourself, what is this company's moat? It could be brand loyalty, patents, cost advantages, a strong distribution system, or network effects. If you don't see a moat, then competitors can easily come in and eat away at profits. A business without a moat is like a castle on a flat plain with no walls. It may look impressive today, but it won't stand for long. Focus on intrinsic value. Now here's where a lot of people get it wrong. They think a stock is just a number on a screen. They watch it go up and down every day and try to play the swings. But to me, a stock is a piece of a business, and every business has an intrinsic value, that is, the true worth of the business, based on the cash it can generate over time. Think of it like buying a farm. If you buy a farm, you don't check the price every day to see if you can sell it for more tomorrow. No, you look at how much corn or soybeans the farm can produce and what that production is worth over the years. That's intrinsic value. When I look at a company, I ask, how much cash will this business generate over the next 10, 20, or 30 years? Then I compare that to the price of the stock. If the stock is selling for less than the business is truly worth, then I have an opportunity. This is where patience comes in. The market is like a voting machine in the short run, but like a weighing machine in the long run. In the short term, people vote with their emotions, fear, greed, excitement. But over time, the true weight, the true value of the business will show itself. That's why I don't worry too much about day-to-day market swings. I focus on intrinsic value. If I can buy $1 for 50 cents, eventually the market will recognize it. The importance of management. When you buy a stock, you're not just buying numbers on a balance sheet. You're buying into the people who run the business, and management matters a lot. I've always said I look for three things in a manager: intelligence, energy, and integrity. If you don't have the last one, the first two will kill you. Why? Because you can have the smartest, hardest working person in the world, but if they're dishonest or unethical, they'll find a way to hurt you. Integrity is non-negotiable. For example, when we bought See's Candies, one of the things that impressed me was the quality of the management team. They cared about the product, the employees, and the customers. They weren't just trying to squeeze every penny, they wanted to build something lasting. So when you're evaluating a stock, look beyond the numbers, read the annual reports, listen to what the managers say, and more importantly, watch what they do. Are they treating shareholders fairly? Are they reinvesting profits wisely? Are they honest about mistakes? A company with great management can survive tough times and come out stronger. A company with poor management can take even the best product and run it into the ground. Avoid debt traps. Here's a piece of advice that can save you a lot of pain. Be very careful with companies that carry too much debt. Debt is like a sword hanging over a company's head. When times are good, it doesn't look so bad. But when a storm comes, that debt can destroy everything. I prefer businesses with strong balance sheets, companies that generate enough cash to fund their operations without relying heavily on borrowed money. Think about it this way. If you own a house outright, you can weather a lot of financial storms. But if you owe the bank every month and you lose your job, things can fall apart very quickly. The same is true for companies. If they're loaded with debt and the economy turns down, they might not survive. But a company with little or no debt can endure the storm and even take advantage of opportunities while others are struggling. So when you're looking at a stock, always check the balance sheet. Ask yourself, how much debt does this company have compared to its earnings? If it looks risky, walk away. There are plenty of fish in the sea. Patience is your superpower. If you remember nothing else from what I'm telling you today, remember this: patience is the investor's greatest superpower. Most people in the market are impatient. They want quick results. They want to double their money overnight. That impatience leads them to buy high and sell low, to chase fads, and to make emotional decisions. But if you can be patient, if you can think in terms of years and decades instead of days and weeks, you have an enormous advantage. When I bought Coca-Cola back in 1988, I didn't buy it because I thought the stock would pop the next day. I bought it because I believed that people would still be drinking Coke 10, 20, and 50 years from then. And I was right. It's the same with American Express, with Apple, with so many of the businesses we own. The key is not to worry about what the stock does tomorrow. The key is to buy a wonderful business at a fair price and then hold it for the long haul. Patience may not be exciting, but it's powerful. Don't get caught in the noise. Now let me warn you about something that can derail even the smartest investors: noise. Turn on the television and you'll hear experts shouting about the next big thing. Open your phone and you'll see endless headlines about market crashes, booms, bubbles, and panics. If you listen to all that, you'll drive yourself crazy. The truth is, the market will always have ups and downs. There will always be people predicting doom and others predicting boom. Most of them are wrong. That's why I don't spend my time watching the market every day. I spend my time reading about businesses, thinking about their long-term prospects, and making decisions based on facts, not emotions. You should do the same. Don't let the noise push you into bad decisions. Keep your head when others are losing theirs. Why temperament matters more than intelligence. I've often said that investing is not a game where the smartest person wins. It's a game where the person with the best temperament wins. What do I mean by temperament? It's the ability to stay calm when others are panicking. It's the discipline to wait when everyone else is rushing. It's the humility to admit when you don't know something. Back in 1973 and 1974, the stock market went through one of its worst bear markets. Stocks were cheap, but people were terrified. Many sold at the bottom. I didn't have to be a genius to make money then. I just had to keep my head when everyone else was losing theirs. And in 2008, during the financial crisis, the same thing happened. People were running for the exits, selling great businesses at bargain prices. That's when we stepped in. We bought companies we believed in because our temperament allowed us to see opportunity instead of just fear. So, when you're picking stocks, remember this: your mind is your biggest asset, but your emotions can be your biggest liability. The margin of safety. One of the most important lessons I learned from my teacher, Ben Graham, is the idea of a margin of safety. Think of it like this. If you're building a bridge that needs to carry 10 tons, you don't design it to carry exactly 10 tons. You design it to carry 15 or 20 tons just to be safe. That margin of safety protects you when things don't go exactly as planned. In investing, the margin of safety means buying a stock for less than its intrinsic value. If you think a business is worth $100 a share, don't pay $100. Wait until it's 70 or 80. That way, even if you're wrong in your calculations, you still have a cushion. The margin of safety is your insurance policy against mistakes, bad luck, or unexpected events. It's one of the simplest but most powerful concepts in investing. Never forget rule number 1. People sometimes laugh when I tell them my 2 rules of investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, of course, in real life, you will sometimes lose money. Nobody bats 1,000. But the point is to avoid big, permanent losses. Because if you lose 50% of your money, you need to double it just to get back to where you started. That's a hole you don't want to dig. How do you follow rule number 1? By being selective, by staying patient, by focusing on quality businesses at fair prices, by having a margin of safety, and by resisting the temptation to gamble on fads or speculation. It's not about swinging at every pitch. It's about avoiding the big mistakes, because in investing, avoiding disaster is often more important than hitting home runs. Don't try to predict the market. Another mistake I see all the time is people trying to predict where the market will go next. They look at charts, they follow experts, they listen to endless predictions. The truth? Nobody knows what the market will do tomorrow, next week, or even next year. When I buy a stock, I don't care what the market does tomorrow. I don't care what the Federal Reserve announces next month. I don't even care if the economy goes into a recession next year. What I care about is whether the business I'm buying will still be valuable and profitable 10 or 20 years from now. If you pick stocks based on long-term value, the daily ups and downs of the market won't matter. They'll look like little ripples in a very long river. So, my advice is simple. Don't waste your time trying to predict the market. Focus on businesses, not markets. Surround yourself with the right people. Here's something you might not expect in a talk about investing. Your friends matter. Who you surround yourself with influences how you think, how you act, and how you invest. If you spend time with people who are always chasing fads, gambling, and speculating, you'll be tempted to do the same. But if you surround yourself with people who are thoughtful, rational, and long-term in their thinking, you'll develop those same qualities. Here's what I want you to remember. Stay within your circle of competence. Look for moats. Focus on intrinsic value. Demand a margin of safety. Pay attention to management and balance sheets. Be patient. Avoid noise and speculation. Keep learning. Surround yourself with the right people.